Welcome! Today, we're diving into the world of credit scores, a number that can shape your financial future. Whether you're applying for a loan, renting an apartment, or even getting a new phone plan, your credit score matters. But what exactly is a credit score, and why is it so important? In this video, we'll break down the basics, explain how credit scores are calculated, and give you actionable tips to improve yours quickly. Let's start by understanding what a credit score really is and why lenders care about it so much. A credit score is a 3-digit number that represents your credit worthiness. In simple terms, it tells lenders how likely you are to repay borrowed money. The most common credit score in the US is the FICO score, which ranges from 300 to 850. The higher your score, the better your chances of getting approved for loans and receiving favorable interest rates. Your credit score is based on your credit history, including how much debt you have, your payment history, and more. Let's explore what goes into this important number. Credit scores play a crucial role in your financial life. Lenders use them to decide whether to approve your loan applications and what interest rates to offer you. A high credit score can save you thousands of dollars over time by qualifying you for lower interest rates. On the other hand, a low score can make borrowing more expensive or even prevent you from getting credit at all. Credit scores can also affect things like renting an apartment, getting a job, or setting up utilities. Clearly, maintaining a good credit score is essential. Credit scores are calculated using several factors from your credit report. The main components include your payment history, amounts owed, length of credit history, new credit, and types of credit used. Each factor has a different weight, with payment history and amounts owed making up the largest portions. Understanding these elements can help you focus your efforts on the areas that matter most when trying to improve your score quickly. Payment history is the single most important factor in your credit score. It tracks whether you've paid your past credit accounts on time. Even one missed or late payment can have a significant negative impact. Lenders want to see a consistent record of on-time payments, as it shows you're reliable and responsible with credit. To boost your score, always pay at least the minimum amount due by the deadline. Setting up automatic payments or reminders can help you stay on track. The second biggest factor is the amount you owe, especially in relation to your total credit limit. This is known as your credit utilization ratio. Ideally, you want to keep your utilization below 30%. For example, if your total credit limit is $10,000, try to keep your balances under $3,000. High utilization signals to lenders that you might be overextended, which can lower your score. Paying down balances is one of the fastest ways to improve your credit score. The length of your credit history makes up 15% of your credit score. This factor considers how long your credit accounts have been open, including the age of your oldest account, the age of your newest account, and the average age of all your accounts. Generally, the longer your credit history, the better. That's why it's usually a good idea to keep old credit cards open, even if you don't use them often. Closing old accounts can actually shorten your credit history and lower your score. New credit makes up 10% of your credit score. Every time you apply for a new credit card or loan, a hard inquiry is added to your credit report. Too many hard inquiries in a short period can lower your score, as it may signal to lenders that you're taking on too much debt. Try to limit new credit applications, especially if you're planning a major purchase like a home or car. Soft inquiries, like checking your own score, don't affect your credit. The final 10% of your credit score comes from the variety of credit accounts you have. This includes credit cards, installment loans, mortgages, and more. Lenders like to see that you can manage different types of credit responsibly. However, don't open new accounts just to diversify. Only take on new credit when you need it. Responsible management of both revolving and installment credit can help your score over time. To improve your credit score, you first need to know where you stand. You're entitled to a free credit report from each of the 3 major credit bureaus, Equifax, Experian, and TransUnion, once a year. Reviewing your report helps you spot errors or fraudulent activity that could be dragging down your score. If you find mistakes, dispute them right away. Keeping an eye on your credit report is a key step in managing your financial health. If you find an error on your credit report, don't panic. You have the right to dispute any inaccurate information. Contact the credit bureau and the company that provided the incorrect data. Provide documentation to support your claim. The bureau must investigate and respond, usually within 30 days. Removing errors can quickly boost your score, especially if the mistake was a late payment or account you didn't open. One of the fastest ways to improve your credit score is to pay all your bills on time, every time. This includes not just credit cards and loans, but also utilities, rent, and even phone bills. Late payments can be reported to the credit bureaus and hurt your score. Setting up automatic payments or calendar reminders can help you stay organized and avoid costly mistakes. High credit card balances can drag down your score, even if you make payments on time. Focus on paying down your balances, starting with cards that have the highest interest rates. If possible, make more than the minimum payment each month. As your balances decrease, your credit utilization ratio improves, which can quickly raise your score. Consider a balance transfer to a lower interest card if it helps you pay off debt faster. While you're working to improve your credit score, try to avoid taking on new debt. Each new loan or credit card application results in a hard inquiry, which can temporarily lower your score. More importantly, new debt increases your overall balances and can make it harder to manage payments. Focus on paying down existing debt before considering new credit. If you have a trusted friend or family member with good credit, ask if you can be added as an authorized user on their credit card. Their positive payment history and low balances can help improve your score, especially if you have a thin credit file. Just make sure the primary account holder manages the account responsibly, as their actions will affect your credit too. Another quick way to improve your credit utilization ratio is to request a credit limit increase on your existing cards. If your income has gone up or you've had a good payment history, your card issuer may approve a higher limit. This doesn't mean you should spend more, but it does lower your utilization percentage, which can boost your score. Just be aware that some issuers may do a hard inquiry when you request an increase. If you have accounts in collections, address them as soon as possible. Paying off collections won't erase them from your report immediately, but it can improve your score over time. Some newer scoring models ignore paid collections, so settling these debts can help. Always get written confirmation that the debt is paid or settled, and check your credit report to ensure it's updated. If you're struggling to make payments, don't ignore the problem. Contact your creditors to discuss your options. Some may offer hardship programs, payment plans, or even settle for less than the full amount owed. Negotiating can help you avoid late payments and collections, both of which hurt your credit score. Always get any agreement in writing before making payments. If you have poor or no credit, a secured credit card can help you build or rebuild your score. With a secured card, you make a deposit that serves as your credit limit. Use the card responsibly and pay your bill on time each month. Over time, your positive payment history will be reported to the credit bureaus, helping to improve your score. Eventually, you may qualify for a regular, unsecured card. Be wary of companies that promise to fix your credit score overnight for a fee. Many of these are scams that can leave you worse off. There's no quick fix for bad credit, and anything a credit repair company can do, you can do yourself for free. Focus on proven strategies like paying bills on time, reducing debt, and disputing errors. If you need help, seek advice from a reputable, nonprofit credit counseling agency. It's important to know the difference between hard and soft credit inquiries. Hard inquiries occur when you apply for new credit and can lower your score slightly. Soft inquiries happen when you check your own score or when a lender pre-approves you for an offer they don't affect your score. Monitoring your credit regularly with soft inquiries is a smart way to stay informed without hurting your score. Improving your credit score isn't always instant, but some actions can have a quick impact. Paying down high balances, correcting errors, and making on-time payments can show results in as little as 30 days. Other changes, like building a longer credit history, take more time. The key is to be consistent and patient. Your score will rise as you demonstrate responsible credit behavior. It's a good idea to check your credit score regularly, but not obsessively. Once a month is usually enough to track your progress and catch any issues early. Many banks and credit card companies offer free credit score updates as a perk. Keeping an eye on your score helps you stay motivated and spot potential problems before they become serious. If you're new to credit, start by opening a secured credit card or becoming an authorized user on someone else's account. Use your card for small purchases and pay the balance in full each month. Over time, your responsible use will help you build a positive credit history. Avoid applying for too many accounts at once, as this can hurt your score. Student loans can help you build credit if managed responsibly. Making on-time payments on your student loans is reported to the credit bureaus and can boost your score over time. However, missed payments or defaulting on loans can seriously damage your credit. If you're struggling, contact your loan servicer to discuss deferment or income-driven repayment options. Closing a credit card account can affect your credit score in two ways. It may shorten your credit history and increase your credit utilization ratio. Unless there's a good reason, like a high annual fee or fraud, it's usually better to keep old accounts open. If you must close an account, try to pay down other balances first to minimize the impact on your utilization ratio. Credit scores typically fall into 5 categories: poor, 300 to 579, fair, 580 to 669, good, 670 to 739, very good, 740 to 799, and excellent, 800 to 850. Most lenders consider a score of 670 or higher to be a good risk. Knowing where you stand can help you set realistic goals and track your progress as you work to improve your score. Lenders use your credit score to assess risk when you apply for credit. A higher score means you're more likely to be approved and receive better terms, like lower interest rates. Some lenders use additional criteria, but your score is often the first thing they check. Understanding how lenders view your score can help you make smarter financial decisions. Landlords often check your credit score when you apply to rent an apartment. A good score can make it easier to get approved and may even help you avoid paying a larger security deposit. If your score is low, consider offering references or a cosigner to strengthen your application. Building your credit can open more housing opportunities. Some employers check credit reports as part of the hiring process, especially for jobs that involve financial responsibility. While they don't see your score, they can view your credit history. A clean report can give you an edge, while negative marks may raise concerns. If you're job hunting, review your credit report and address any issues in advance. Did you know your credit score can affect your insurance premiums? Many insurers use credit-based insurance scores to help determine rates for auto and homeowners insurance. A higher score can mean lower premiums, while a lower score may cost you more. Maintaining good credit can save you money in more ways than one. Utility companies may check your credit before setting up service. A good score can help you avoid paying a deposit or get better terms. If your score is low, you may need to pay a larger deposit or provide a cosigner. Improving your credit can make it easier and cheaper to set up essential services like electricity, water, and internet. There are many tools available to help you monitor your credit. Some are free, while others charge a fee for more detailed reports and alerts. Regular monitoring helps you catch errors, spot fraud, and track your progress. Choose a reputable service and use it to stay informed about changes to your credit profile. Identity theft can wreak havoc on your credit score. If someone opens accounts in your name or racks up debt, your score can plummet. Protect yourself by monitoring your credit, using strong passwords, and freezing your credit if you suspect fraud. If you're a victim, report it immediately and work with the credit bureaus to correct your report. A credit freeze prevents lenders from accessing your credit report, making it harder for identity thieves to open new accounts. A fraud alert warns lenders to verify your identity before extending credit. Both tools can help protect your credit, but they work differently. Consider using them if you're concerned about identity theft. There are many myths about credit scores. For example, checking your own score does not hurt it, and carrying a balance does not help your score. In fact, it can cost you in interest. Closing accounts doesn't always improve your score, and paying off debt is always a good thing. Understanding the facts can help you make smarter decisions. How long does it take to improve your credit score? The answer depends on your starting point and the actions you take. Quick fixes like paying down high balances or correcting errors can show results in a month or two. Building a long, positive history takes time, usually several months to years. The most important thing is to stick with good habits and be patient. Many apps can help you track and improve your credit score. These apps offer features like score monitoring, personalized tips, and alerts for changes. Some even simulate how different actions might affect your score. Choose an app from a reputable provider and use it as a tool to stay on top of your credit health. If you're overwhelmed by debt or struggling to improve your credit, consider working with a nonprofit credit counseling agency. These organizations offer free or low-cost advice, help you create a budget, and may negotiate with creditors on your behalf. Avoid for-profit companies that charge high fees or make unrealistic promises. Credit bureaus collect and maintain your credit information. The three major bureaus in the US are Equifax, Experian, and TransUnion. Each bureau may have slightly different information, so it's important to check all three reports. Lenders report your activity to these bureaus, which then calculate your credit score based on their data. Your credit score and credit report are related but not the same. Your credit report is a detailed record of your credit history, including accounts, payments, and inquiries. Your credit score is a numerical summary based on the information in your report. Reviewing both helps you understand your financial standing and spot areas for improvement. Building and maintaining a high credit score is about developing good long-term habits. Always pay your bills on time, keep balances low, avoid unnecessary new debt, and check your credit regularly. Over time, these habits will help you achieve and maintain excellent credit, opening doors to better financial opportunities. Set realistic credit goals based on your current score and financial needs. Whether you want to buy a home, get a new car, or simply qualify for better rates, knowing your target score can help you stay motivated, track your progress, and celebrate milestones along the way. Remember, improving your credit is a journey, not a sprint. Let's recap the key steps to improve your credit score fast. Pay all bills on time, reduce your credit card balances, check your credit report for errors, avoid unnecessary new debt, and use tools like secured cards or authorized user status if needed. Consistency and patience are your best allies. With these strategies, you'll be on your way to a stronger financial future. Improving your credit score may seem overwhelming at first, but every positive step you take makes a difference. Remember, your credit score is just one part of your financial picture. Stay focused, be patient, and celebrate your progress. With time and effort, you can achieve your credit goals and enjoy greater financial freedom. Thanks for watching, and here's to your credit success.